The impact and images from Hurricane Helene and now Hurricane Milton have placed flood insurance in a new light for many. Even with the U.S. Congress recently agreeing to a short term extension of the National Flood Insurance Plan, any long term solution to the federal program likely would need private flood insurers to take on more risk. This is just one more of the issues analyzed in a new research report from AM Best. We're joined today by one of the report's authors, senior industry analyst Chris Graham. So, Chris, the National Flood Insurance Program has long served as the main provider of flood insurance, but done so with the backing of the federal government and by carrying a significant level of debt. Where does that debt level stand at present, and what's contributed to that along the way?
Uh, Good morning, John. Thank you for having me today. Uh, yeah, so the program started in the late 60s, yeah, pretty much to cover river flooding. Flood is not covered by by homeowners policies or even commercial property policies in general. At the time when when the National Flood Insurance Program started, insurers didn't think flood was commercially insurable. Uh, the only people who they thought would want it would, or the only people they thought would ever make a claim would be the ones who buy it, and there was no way to spread the risk. So the government program came to be, and it worked very well in the sense that it was financially sustainable up until Hurricane Katrina, and since then, it's been the tropical systems that have bought, large debt to the program. So, right now the debt sits at about $21 billion, and that was before the hurricane season this year. So I would expect we're going to see that to come up. It's been driven by, like I said, when the program went into debt with Hurricane Katrina and never came out. There was Hurricane Ike a couple years later. Sandy was a big one that contributed to the debt. Hurricane Harvey was a big one that contributed to the debt. Uh, the so it's been the tropical systems. Even at that, the 21 billion, it's after that number is reduced by a forgiveness of $16 billion in debt. So you can see how the tropical systems have driven it through the years, and that's why I think hurricanes Helene and now Milton are going to add to that. We've seen the devastation mainly inland from Hurricane Helene. Yes, there was storm surge, but we've seen a lot in in Appalachia, in even into Tennessee and in Georgia from the rainfall from Hurricane Helene. Uh, Milton, there's some big storm surge on both coasts and some heavy rainfall. There was a slight reversal of flow of the St. Johns River in Florida, so there's going to be a lot more flood losses to come as well. So I would imagine that 21 billion is going to increase.
In theory, though, the NFIP's Risk Rating 2.0 was designed to address these pricing shortfalls and better determine an adequate risk charge. From a practical standpoint, what's been the impact of that so far?
Well, we'll start to get a good look at the impact of the risk rating 2.0. Yes, premiums for a number of homeowners, and well, I say homeowners, I guess we should stick with property owners because it's commercial property as well, will have increased, but those increases are phased in over time. They're capped at 18% a year. So anyone that needed, more than 18% rate increase to get to an actuarially sound rate, it's still underpriced. So it's going to take, it could take up to 5 years for all properties to get to an actuarially sound rate. And that's, assuming rates would be flat over that time. So it could be a while yet before we see the full impact as far as getting to an appropriate premium level for some of these properties. Um, we may, or one of the initial impacts we did see is somewhat of a movement to private flood insurance. There has been an increased interest in some insurers writing uh, flood on their own, and this is not like the write your own program that's supported by the federal government anyway. This is, they're actually bearing the risk, and an increase in federal pricing might make the private pricing more competitive. We'll see how much moves, but there was a big bump in the first year, as far as what share the private market had of the total flood insurance. Um, where that goes, now we don't know. It was relatively flat in 23 as far as market share. So we'll see what the second year and third year of increased NFIP pricing brings.
That being the case, what are the implications from Hurricane Helene and now Hurricane Milton with respect to flooding trends and coverage issues as the industry makes its way through hurricane season?
Well, I think there's, unfortunately, I think there's going to be a lot of people who find that flood isn't covered by their homeowner's insurance policy. If they didn't know that before, they may find out the hard way now. It's easy to look at flood and think it's, not going to happen because it's usually phrased as a 100-year event, or one every 250. Well, if you're at a 100-year event, that's a 1% chance of it happening in a given year. If you're in your house for 30 years, that means you have a 26% chance of experiencing a flood in the time you're in the house. So, it's like, you look at it, is it worth protecting the investment? Yeah, you have a 26% chance. What's the chance of hitting the lottery? People run out to buy a lottery because they think, oh, this would be great. Well, what about protecting your home? There's a 26% chance you're going to experience a flood if you're in that 1% area. So, yeah, buy the flood insurance to protect your home. Hopefully, people start doing that. That's really what's going to move, the market is, how many more people are willing to take up flood insurance, um, and then how many insurers are willing to write it. One thing you have with flood versus other perils, and this is why it's generally been viewed as not commercially insurable. If one insurer writes a whole street, say in a town, there might be a robbery on that street. The likelihood that every house is getting robbed at the same time is pretty slim. That's not the case with flood. If one house floods, it's a good chance they're all flooding because there's some body of water right there that, overflowed. So no one wants to take too much flood insurance at any one time because of how much any one area would get hit at the same time.
The classic example of concentration of risk.
That's exactly what it is with flood. So, to get more people insured for flood, one, they have to want it, and there has to be, a larger play, more from the commercial market coming in.
Thanks, Chris.
Thanks, John.
That was Senior Industry Analyst Chris Graham. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.